Good morning, everyone. Hello and welcome to the weekly commodity audiocast. I am Kainat Chenwala from Kotak Securities Commodities Research Desk. And like in every episode, today also we will be navigating through the ever-changing landscape of commodity markets, examining the events that influence market sentiments and uncovering the latest trends. So let's begin this week's podcast. This week, traders were on edge, markets were on edge because of escalation of Israel-Iran conflict and recalibration of expectations regarding Federal Reserve interest rate cuts. Dollar maintained held steady above 106 levels as stronger than anticipated US retail sales and hawkish comments from Fed officials reinforced expectations that the Fed would postpone initiating rate cuts. In March, we saw a 0.7% increase in US retail sales, reaching $709.6 billion, following a revised upward revision in Feb figures of 0.9%. Compared to the previous year, March figure was 4% higher, indicating that consumer spending outpaced the inflation rate of 3.5% for the month. Also, jobless claims in the US remain stable at 212,000, highlighting a remarkably robust labor market with minimal layoffs and exceptionally low unemployment rates. Also, several comments from Fed officials and Fed Chair were perceived as hawkish. Federal Reserve Bank of Cleveland President Loretta Mester expressed confidence in the current state of monetary policy, suggesting that the Fed could maintain interest rates at their current levels. Similarly, Atlanta's Raphael Bostic noted that the path to achieving 2% inflation would likely be slower than anticipated, advocating for a reduction in borrowing costs towards the end of the year. Also, Minneapolis Fed counterpart Neil Kashkari emphasized the necessity for greater certainty regarding declining inflation before considering interest rate cuts, suggesting such actions might be delayed until after 2024. Expectations of imminent rate cuts diminished notably as Fed Chair Powell acknowledged the lack of further progress on inflation this year, hinting at a postponement of the much-awaited pivot. This, coupled with renewed conflict in the Middle East, spurred investment in the dollar and US treasuries while causing unease in global equities. S&P 500 dipped below 5,000 levels, while Nasdaq plummeted 5% for the week, and the Nikkei led losses in the Asian markets at 6%. Talking about commodities, gold prices marked their fifth consecutive weekly gain, trading well above $2,400 per ounce, buoyed by geopolitical tensions, robust Chinese demand, both investment and central bank, and a sharp rise in speculative buying. Despite this surge, a potential pullback in gold prices may occur if further escalation in the Middle East is avoided. Despite the fact that MCX June futures closed at an all-time high this week, the markets appears to be losing steam after trading in a relatively narrow range on Thursday and Friday. However, prices are trading above super trend 7.3 and 20 SMA, confirming bullish short-term trend is still intact. Nearest support lies at 72,275, while nearest resistance lies at 73,315 levels. Prices may continue its bullish momentum if it breaks and sustains above all-time high of 73,958. In addition to the uptick in gold and industrial metals, a bullish demand outlook from the Silver Institute pushed silver to close the week with more than 1% weekly advance. LME base metals extended gains for the third consecutive week, with some experiencing pressure on visible inventories on the LME in response to the recent sanctions, while others benefited from concentrate tightness. On the price action front, MCX Aluminium April futures continued its bullish momentum, closing at a 20-month high after opening the gap up this week. Bollinger Bands have expanded, indicating increase in volatility. RSI 14 is above 85, indicating price may be in an overbought zone. Right now, the nearest support lies at 234 levels, whereas nearest resistance is at 250 levels. Talking about crude prices, WTI crude surged to $86.3 per barrel on Friday following unverified reports of explosions in Iran, Iraq, and Syria. However, prices reversed and closed the week 3% lower at $83.5 per barrel as Tehran downplayed the attack, stating that it was not compelled to react to the blasts. Despite discussions of fresh sanctions against Iran and the US reimposing oil sanctions on Venezuela, crude oil prices largely remained under pressure this week. Now, Risk of a broader regional conflict in the Middle East remains elevated as Israel has retaliated against targets in Iran in response to an unprecedented missile and drone attack over the weekend. Moreover, a strong dollar and elevated yields, with swaps pricing in the first quarter point cut by September and less than 45 bips total cuts for the year. Uh, so this does not really bode well for the market sentiments either. Apart from that, we saw the Japan CPI reading, which excludes fresh food and energy, decreased from 3.2% to 2.9%, falling below the forecast of 3%. This is the first time since November 2022 that the index has dropped below the 3% mark. So this unexpected easing in CPI in March may complicate the BOJ policy decision next week. Also, next week we have a few data points coming in from the US, most importantly US Q1 GDP estimates and core PCE price index. So, if US GDP estimates and core PCE price index turn up higher than expected, it may reinforce the higher for longer narrative and further unsettle markets. Also, on the data front, we have PMI figures coming in from major global economies. So, that will throw some light on the business activity. Also, overall, the for the next week, we expect lingering tensions in the Middle East and the upcoming US PCE figures to challenge investors' confidence. So that these two events would be most likely in focus for the next week. So, on that note, we conclude this edition of Commodity Audiocast, and we believe that we have offered you valuable insights. Thank you so much for tuning in today, and we eagerly anticipate your presence with us again next week. Until then, happy trading. Thank you so much.